Good afternoon and welcome to BizTech Midday Market Watch. Our guest today is Stephen Innes, Chief Global Market Strategist at AxiCorp. Steve, great to have you on the show.
Thanks for having me, Brian. Good to see you again.
Yeah, it's been a long time, I think, but it's really great that this is your first time on BizTech, and I hope to see you on more midday market calls.
Great. I'm looking forward to it myself, Brian.
Now, let's zoom over to the US now. I mean, that's dominating market sentiment right now, the elections. Now, is the prospect of a blue wave still largely ruling market sentiment, or is the narrowing of the Biden lead in the polls causing a bit more uncertainty in markets?
You know, I think the narrowing of the polls is playing a little bit of the effect, but I think if you just look or talk to people in the market, it's really the contested election that's weighing on sentiment, which would imply we're going to have a delay in the stimulus package. That's really, I think, what's driving sentiment right now. This is a market that's in desperate need of a lifeline, and I think it's a stimulus narrative that remains at the end of that lifeline, and that's what the markets are tugging on. I think looking at the current poll numbers, okay, we've seen polls be wrong.
And the polls have been wrong.
Yeah. I'm thinking now that the pollsters have put in enough skew to compensate for the shy Trump vote. They don't want to look stupid. They want to keep their jobs. They want to make themselves relevant for the next election. So I think that skew is really in place. And I don't see Trump coming back here. And I think what's happening right now is I think once people realize that the contested election is not going to be so contested. In other words, if the Biden sweep, and particularly in the Senate, is convincing enough, I think we'll have people racing for those reflation trades right off the bat. Positioning is very clean right now. We've seen a significant risk reduction, which was really part of the U.S. pre-election risk reduction, but is also getting compounded by these COVID waves that have been forcing large parts of Europe into lockdown. So I think the runway is clear for the reflation trade, but it's up to the blue wave to deliver now. And once that comes through, I think the market celebrates.
Okay, let me take a doomsday scenario and we have a shock Trump victory. How do you think will Asian markets react to that?
You know, it's interesting. The current narrative is that Asia is going to collapse. It will not. It will not. This is what you'll read in the press. I think, sure, there'll be a little bit more influential knee-jerk reaction because of possible heightened trade war rhetoric. But what are we talking about? We're going to talk a little bit of a sell-off, but trade war only becomes relevant if it becomes negative for the economy. Talking about trade war is a lot different from really having a trade war. I think the next level of angst that's going to continue playing out is going to be Trade War 3, which is all going to center around technology. I think we're seeing a divorce away from the global supply chains. I think those are not that significant right now. Therefore, trade war is not going to be overly significant. I think technology is the big battleground now, where both China and the US are fighting over for dominance of the internet. That's where the real war is going to take place. Will that impact supply chains? Probably not. It'll impact certain supply chains around technology.
But Steve, isn't China's now new narrative really to almost set up a parallel supply chain of their own? And that's just come out of the meeting last week with the Communist Party meeting last week.
That's why I think, escalating trade war is going to be mute, because of the 5-year plan is all about internal consumption and reestablishing those supply chains internally in China. So, we'll have a knee-jerk reaction. Then people say, but, China's all roads lead through Beijing, especially the new Belt and Road Initiative. And I think that'll start to ease the angst. And I think that'll be a realization will come back to the markets quickly. It's easy just to flip the switch the other way on say you're playing for a Biden reflation trade. It's easy to flip the switch the other way, but I don't think on a Trump win. But I don't think it's that easy of a trade decision. I think looking at both sides of the equation, whether it's a Trump win or a Biden win, I think stocks go up. I think there's two impulses there. One, the Biden presidency is a stimulus, whereas the Trump is non-regulation and non-tax. So both are favorable over the short term for stocks.
And that's favorable for the dollar as well.
No, it's not going to be favorable for the dollar.
No.
Both, I think the Trump win knee-jerk will be favorable for the dollar. I think the stimulus impulse will be negative for the
Negative,
dollar
yeah.
simply because it's going to inflate those dueling or that budget deficit, and that should theoretically be negative for the U.S. dollar. But the whole market's complicated right now. There's nothing ever easy about trying to call where the currency markets are going to go because, we look at G10 currencies right now. They're getting so negatively impacted by the rise in COVID in Europe, particularly the euro and the pound. And when has the U.S. dollar ever sold off without the euro taking the lead? I think what's happening now is we're pivoting over to Europe, or pivoting from Europe over to Asia. And I think it's the gravitational pull of the yuan that's probably going to take charge of the overall US dollar narrative. I think under a Biden presidency, we're going to see the yuan continue to strengthen, albeit a little bit slower pace than what we saw it strengthen over the past month, simply because the PBOC had stepped in multiple times just to curb the enthusiastic rally in the yuan over the last couple of weeks. I think it rallies, but it rallies on an even pace, provided the PBOC is happy with the pace that it's going.
Now, Stephen, let's pivot a little bit closer to home, to Malaysia, where Budget 2021 is set to be unveiled this Friday. Now, given the political uncertainty that surrounded Malaysia this year, basically, essentially had change of governments, there's uncertainty. There was with almost another change of government, potentially. With Anwar coming in and saying that he has the numbers. What signals are investors and market actors looking at to come out of Malaysia?
It's that omnipresent cloud or political cloud that always hangs over Malaysia. Well, it's seemingly hung over Malaysia since the 1MDB scandal cropped up, and we're talking years now that we've had to deal with the fallout from this, and I still think we continue to deal with the fallout from this. Which is getting reflected through budget concerns and areas that should have been fixed many years ago are still lingering concerns. I think.
What are these concerns? I mean, could you highlight some of these things which investors still worry about Malaysia?
Well, when it comes to Malaysia, political risk is at the forefront, but it's also the problems with the deficit, which is the biggest issue, and whether that's sustainable from a GDP perspective.
But isn't that deficit question, Steve, something that we throw out the window now, given the current pandemic?
You would think so, but but Malaysia's in a bad spot typically, right? And I think what they've tried to do over time is issued some type of fiscal prudence, and I think this may be reflected in the 2020 budget that might not be as expansive as maybe the markets actually need, and I think that's a possible risk that could be faced. Now is the time to lavish the market, arguably, with stimulus, but they're riding that very narrow fence of possible rating issue. Now that's a problem. If you get downgraded, that's the biggest problem. So you have to play the fiscal prudent line, not to go blow your budgets too badly, because if your bonds get derated enough, that eliminates a lot of people that are currently buying them, and that's a bit of a problem. It'll create a massive wave of outflows from the capital markets, both on bonds and stocks. It's a very fine line. Fortunately, Malaysia's got a great central bank that really understands the overall landscape and has been providing suitable backstop. They've kept their policy rather tight, in my view, and I think for reasons that we're seeing right now, because they were convinced that they needed to hold that policy wiggle room because they knew that there would be a second wave virus hitting the markets. And we all did, but other central banks are at the end of the runway as far as using conventional methods to stimulate the economy. BNM isn't. They've got policy wiggle room. The advantage that Malaysia has by keeping those bond ratings intact is that they're, from a real interest rate advantage, it's very favorable to attract capital market flows versus the U.S. They have to keep that bond rating intact, and I think that's one of the big issues that we're going to see come up in the budget 2021. Might not be lavish, but it's probably going to be supportive, but it's not going to be extreme.
Steve, thank you very much for your insights. We've been speaking to Stephen Innes, Chief Global Market Strategist at AxiCorp, on BizTech's Midday Market Watch. I'm Brian Fernandez. Check out www